Well, it finally happened, at least for the month of January. Welcome to the Grand Rapids, Michigan, Kent County Residential Real Estate Market Update with data through January 2023. My name is Rodney Constable. I'm a realtor with 616 Realty out of Grand Rapids, Michigan. Year over year, home prices did fall during the month of January 2023 by 2.56%. The average home in Grand Rapids in the Kent County area in January of 2023 sold for $310,463. Now, when we look at the last 8 years, and what we're looking at here is January only year over year. So these are the selling prices during the month of January for Kent County, right, which is basically Grand Rapids, Michigan. And this is just what these homes sold for in January of each year. And what we can see is that the $310,463 sales price, the average sales price for the month of January 2023, was about $8,000 less than what the average home sold for during 2022. However, when we step back one more year and you look at 2021, you can see that we're still about 40,000, a little over 40,000 over where we were 2 years ago, okay? So, and I want to caution you that this is 1 month, right? So, and it's a small data set relative to the entire year. So let's not get too excited, but to be technically accurate, yes, the average selling price during the month of January of 2023 was a little over 2.5%, a little over $8,000 less than what a home sold for on average during the month of 2022 for Kent County, Michigan. All right, so what we're also seeing here is the average days of home being on the market is expanding out a little bit. So we're up to 30 now, where we have been in the 20s or even in the teens for the last couple of years. And this is not actually a bad thing, all right? So this could provide some balance to the market, as we know, for many, many years. And guys, I want to be clear, it's still a seller's market, okay, by a long shot here. But these types of data points where a home sits on the market for a little bit longer, this could provide actually some equilibrium here, right? Some, starting to bring a little bit more balance, because we've been extremely out of balance for many years, and that'll make more sense as we go through the presentation here. All right, so the average days on market for homes sold during the month of January, again, small data set because we're looking at just the month of January so far for 2023, but the average home stayed on the market for 30 days before it sold. Now, the inventory of unsold homes, however, as of the end of January, had been on the market for a total of 86 days, an average of 86 days. So what these two data points do tell us, though, right, the difference between the sold at 30 days and the unsold at 86, is that if a home is properly priced, it's still going to sell in about a month. However, if a home is not properly priced for its location, condition, and amenities, it's going to stay on the market for an extended period of time, right now about 3 months. All right, so let's take a look at year-to-date new listings. Now, this is, again, one of those data points that is actually a good thing, right? Maybe a little counterintuitive, and again, that'll make more sense as we go through the entire presentation. So please, guys, watch this entire presentation at least once, if not twice, which I hope you do every month, because there is a tremendous amount of information in this, and it's economic in nature, it's financial, and remember, I'm a former financial advisor, former VP of a major mutual fund company, including being a realtor now for many, many years, and I've got an entire family, right, of realtors. So I grew up in this business, and I've been in and around it for basically all of my life, because my grandmother was a realtor, my cousin's a realtor, my aunt's a realtor. So this is in my blood. All right, but I'm pretty geeky about this stuff. All right. So anyway, year-to-date new listings versus the same period 1 year ago. Again, we're looking at January of 2023 versus January 2022. We did tick up on the new listings by 11.09%. Now, before we get too excited, I do want you to understand that that's a total of 49 listings, all right? So what we had during the month of 2023 were 491 listings came to market in Kent County versus 442 last year. But when we look down, and we now have 8 years of data to look at, remember, I like to look at long-run data, right? As a financial guy, I like to look at long-run data, so we're not just looking at small data sets. It gives us a bigger perspective. But what we can see is, yes, we did add, right, versus where we were last year, 49 listings versus the 442 we had last year. That brings us up to 491 for the month of January 2023. That is 11.09% over what we had last year. But if we scroll down, we can clearly see that the last 2 years, 2022 and 2023, for the month of January, by far the lowest years, right, that we've seen. So when we're looking at January year over year for the last 8 years, we can clearly see that even though we're up 11.09% in listings versus what we had last year, we're still well below any other year over the last 8 years. All right. So again, we've got fewer and fewer listings come to market, and now let's take a look at the closed transactions where the rubber actually meets the road, especially for those of us like myself that I don't make any money, right, until something closes. I can do a lot of work, but I don't get paid until that transaction closes. All right. So in this category, we're actually down 12.55% versus a year ago. All right. So just to scroll back here for a second, the listings ticked up, but the actual closed transactions fell by over 12.5%. So you can see here over the last 8 years, right, starting in 2023, there were 425 closed transactions during the month of January 2023 versus 486 last year. And just like the listings, when we scroll down and look at the last 8 years, we can clearly see that 2022 and now 2023, by far the lowest closings, and at 425, right, for the month of January 2023, you can clearly see that that is the lowest amount of closings that we've had during the month of January for the last 8 years. All right, so we're down 61 homes versus where we were last year. That's that 12.55% differential. But I think, and I hope you're getting the key takeaway here, guys, that this is the lowest over the last 8 years. This is the lowest amount of closings that we've had in Kent County for the last 8 years. So this is, part of what is happening here, right? In the real estate, people, well, the real estate market's slowing down. Well, yeah, the industry itself. And a lot of this has to do with this slide right here. All right. Now, this goes back to my financial services days, so please bear with me. This is super important for you to understand. By the way, this chart I get from stockcharts.com. From a compliance standpoint, I have to mention that this is a service that I've been using for over 18 years. This is something I pay for. All right. So again, the chart is courtesy of stockcharts.com. Now, what we're looking at here is the 30-year mortgage rate on a weekly basis. So it's a line chart, right? And I'm going to use my cursor here. So we've got 50 years of data going clear back to 1980, but we're looking here at the 30-year mortgage rate, all right? So here's the calendar years at the bottom, and you've got the interest rate over here on the right axis. And what we can see is, yes, interest rates have risen a lot over the last couple of years. However, we need to put this in perspective from a historical measure and a historical perspective. And right now, yes, we're a little over 6%, all right? And this chart is current as of February 17th. You can see where my cursor is moving. We closed at 6.32% as of February 17th, the last weekly close, of course, on this. And we were at 6.32% on a 30-year fixed rate mortgage. Well, we can, and this is on an average, right? It's going to change, of course, depending on which lender you go to and your FICO score and all that. But on average, we're about 6.25, 6.3. So when we go to the left, though, all right, we can see that where we're at now, right, from a historical perspective, is where we were roughly during 2002, 3, 4, 5, 6, 7, 8, and it was only starting in 2009, right, because of the quote-unquote housing crash, right? And there was a lot of things that went on. People were getting mortgages they shouldn't have been able to get. People were being financed for homes they couldn't afford. So we had a speculative bubble here. That is not the case now. Actually, we have quite the opposite, and I'll touch on that here in a second. But you can see here that it was only starting in 2009 that we got below 5.5% for any length of time. And then, of course, because of COVID, we had a massive amount of stimulus, and the government drove interest rates down. Now, keep in mind, and maybe in a future video I'll touch on this, but the 30-year mortgage is actually really constructed off the 10-year Treasury. Not to get too geeky here, guys, but I want you to understand it really has a higher correlation, right? The 30-year mortgage rate has a higher correlation to the 10-year Treasury yield, the U.S. 10-year Treasury yield, than it does the Fed funds rate. If you hear the talking heads on the TV talking about the Fed funds rate, the Fed raised rates or dropped rates or whatever, that is not going to affect your 30-year mortgage rate as much as the 10-year Treasury yield, all right? And as a ballpark, and again, I'm not going to get too deep, but I just want you to give some framework here. If you find the 10-year Treasury yield and you add 200 to 250 basis points on average, that's 2 to 2.5%, that's going to roughly get you the 30-year mortgage rate, all right? So, and again, over the next few months, I'll touch more on that, and I might even create a whole separate video. I probably will create a whole separate video just on the mortgage rates here to help educate people. But I want you to understand that a couple of things here, guys. If you're maybe a first-time home buyer in your 20s, 30s, whatever, and you're thinking about buying a home, but you're going to wait until mortgages go back to 3% or below, you might as well just plan on renting for the rest of your life, all right? And I'm being quite serious because, first off, let's look at the statistical probabilities. When did we have a sub-3 30-year mortgage? Right down here in the lower right of this chart where my cursor is circling, that really happened only for about a year and a half during 2021 and 2022, and really not for the whole years, right? So we really had about a year where you could have got a 30, if you had the right FICO score, all that, you could have got a 3 or sub-3 30-year mortgage, and that's it, right? And you can see, even down in here, 3.5 to 4.5 or 5 was where we spent the majority of the time, starting in 2012 until the COVID downturn in 2020. All right. The point is, guys, we might pull back to 5.5 or whatever, but the reality is we're probably right around here, somewhere between 5.5 and 6.5 is more than likely, if you look from a statistical probability standpoint, where the 30-year mortgage is going to settle in. All right. And again, remember what I was telling you. It's the 10-year Treasury plus 2 to 2.5%. 200 to 250 basis points for us financial geeks. So what this means is that unless the 30-year mortgage or the 10-year Treasury, drops substantially, and that's probably with inflation, right? Now, again, not to get too geeky, but I want you to understand how this works, but I also want you to understand how I think, and that the fact that I know this stuff and you can trust me to be your realtor, all right? I want to be your realtor, all right? If you're moving from out of state, you want to have somebody you can trust that knows what they're doing, give me a call. I get a lot of people from all over the nation now that are finding these videos and they want to move to a lower cost area to live. They're moving away from the coastal areas and they want to live in a nice place with the 4 seasons, beautiful summers. They want to experience winter, right? I get people from Chicago or Arizona, whatever, calling me and saying, hey, I can, sell my place and come over and buy, the same house or a nicer house for half the money. And that is the case, all right? I'll give you my contact information again here towards the end of the video. Of course, it was on the earlier slide. So please give me a call. We'll talk about what you're looking at, whether you're here in Michigan. I get a lot of people moving from Detroit over to Grand Rapids, right? I help those people, whether you're here in Grand Rapids already. I just, last week closed on a house up in Manistee, right? A second home for one of my buyers. So guys, whatever you're looking at doing in the state of Michigan, please give me a call and I'll help you. Okay. But anyway, we better get used to the 30-year mortgage about where it's at, all right, guys? Because please do not wait to buy a house because you're waiting for mortgages to go back down to an unsustainable level. All right, this was an unsustainable level that was brought about because of government stimulus that was brought about because of the pandemic. All right, so and look, if mortgage rates do miraculously go back down to 4% or whatever, which I don't think that's a very high probability anytime soon, you can refinance, okay? But over time, you're going to continue to see home prices continue to rise because of low inventory, and I'm going to touch on that here in a second. And that is not going to change because of something I'm about to tell you. That we're going to be, we're going to be in that mode, guys. We're probably going to be in a seller's mode for many, many years, a decade or more. Because of the lack of inventory, all right? And I'll touch on that. There's just so much to share with you this month, guys, so please stay with the video. Watch it multiple times. But the bottom line on this chart, guys, get used to mortgage rates about where they are because this is probably normal. And you can see, right, let's take this a step further. Let's go from 2002 and backwards, right, beginning of 2002. We're lower, right, this 6.5 line where you see my cursor moving, right? We were above 6.5% on a 30-year mortgage from basically 2001 all the way back to 1980s. And you can see in the 80s, it was in the high teens, right? 18% mortgage. I remember my parents having a 14% mortgage when I was a kid, all right? So, guys, a 6%, plus or minus mortgage is still on a historical basis a very good rate, okay? So please look at the math here. Look at the facts. This is what I'm trying to educate you so you understand it's not my opinion. This is history. These are the facts. And from a historical perspective, we have spent the bulk of history with 30-year mortgage rates in the U.S. above where they are right now, even though they've risen substantially over the last year or so, right? And even since the beginning of 2022, that is equalization. That is a regression to the mean, as we say in finance. We have regressed back to the mean, right? And so we're right in this range here, and we're probably going to spend, would be my guess, the bulk of our time over the next few years in 5.5 to 6.5% range. Let's call it 6% plus or minus, right? That would make a lot of sense, all right? And again, if mortgage rates roll over and fall substantially, refinance and lock in a better rate. Now, this also brings me to another point. Because interest rates were so low down in here and even low for the last decade, again, don't expect them to return to these levels anytime soon. It could happen, but I don't think it's very likely. But anybody with a mortgage, and I've seen some recent data that said 85% of current mortgage holders, so anybody that currently has a mortgage on their home, right? And keep in mind that about 38% or so of all homes are paid for. 65% of all people own a home. The rest of the people rent. So those people that still have a mortgage on the home, 85% of those, according to recent data, have a mortgage that is lower than the current rate. Now, why does that matter? Because they're going to be very hesitant about selling their home, putting their home on the market, and moving. Why does that matter? Well, because that means existing homes, right? Not new builds, but homes that are somebody's already lived in them. They're not brand new builds from that you're buying directly from a builder, right? It's called existing inventory. Those homes, people are not going to be putting them on the market as at the same rate that they used to in the past. Even if they want to move, even if they want a larger home, or as they get older, maybe they're empty nesters, the kids have all moved out, they're grandparents now, whatever. Historically, maybe they would have said, let's downsize. We don't need such a big house. Well, if they still owe on their property and they have a mortgage that is lower than the current mortgage rate, these people, 85% or so of all mortgage holders right now, are going to be very hesitant to sell their home, because if they do have to have a new mortgage, right, unless they're going to pay cash for the property, the new property they're acquiring, they're going to be very hesitant about putting their home on the market, because they're going to have to take on a mortgage at a higher interest rate than what they currently have. All right. Again, I know I'm spending a lot of time on this chart, guys, but this tells the whole story. This is why you need to understand this, because it paints the entire picture of what's happening. All right. And we have underbuilt on top of that, right? We're at least, from the data that I've seen from the National Association of Realtors, from Fannie Mae, Freddie Mac, all of the mortgage companies that are quasi-government entities that put out some very good information. I've seen anywhere from 1 million to 3 million homes short in the United States. We have underbuilt homes starting really in about 2007, 2008 because of the home correction, right? What happened back there. So we've underbuilt homes over the last few years. Builders have not been building like they used to in the past. At the same time, there's been more and more household formation, and that is, millennials, younger people, people in their 20s and 30s getting together, becoming couples, forming households. And there's more and more demand for housing, but there's fewer and fewer homes that have been built over the last decade or so, 10, 12, 14 years. And on top of that, now the existing inventory is not going to turn over at the same rate that it has in the past, because those people with mortgages on their homes that would like to sell their home otherwise are going to say, you know what, I'm not going to do it. I'm just going to stay where I'm at. Maybe the home isn't as nice as we want. Maybe it's not as big as we want. Maybe we'd rather live in a slightly different area. But unless they have to sell, right, for a job change or health reasons, or somebody passed away, divorce, whatever, right, those types of transactions will still happen, right? Death, divorce, job change. But people moving just to move, we're probably not going to see that same level of turnover as we did in the past. All right. So I know I've thrown a lot at you guys, but this is what's going on in the real estate market. This tells the whole story in combination with all of the other data points that I'm sharing with you in this presentation. Now let's take a look at the average months of inventory in Kent County. So what we're looking at here is based on the current sell rate and the amount of homes that are currently listed. If no new homes came to market, how long would it take us to clear the existing inventory? The answer right now is 1 month. It's 30 plus or minus days. All right. In 2022, we were at 0.9 months. That's about 27 days. And in 2021, we were at 0.6 months of inventory for the entire calendar year of 2021. That's about 18 days. So you can see over the last 3 years, right, 2021, 2022, and 2023, it's ticking up. And we're now looking at 11 years of data here, right? This data goes back a little bit further. I have this data back to 2013, so I give you all of this. But we can clearly see, going down the chart and looking at all the other years, that where we're at right now so far for 2023, and again, it's only 1 month of data. We'll have to see after we get a few more months and get the whole calendar year, we'll see what happens. But right now, we're still setting at a lower inventory level, right? Average months of inventory. We're still setting at a lower inventory level than any other time except for the last 2 years, all right? And if we go down, the highest monthly inventory number that we had was back in 2014 at 2.3 months of inventory. And guys, I'm telling you, even 2.3 months of inventory is a really, really low inventory number. So why does inventory matter? Well, as we can see here, if you have between 1 and 2 months of inventory, you probably are going to experience double-digit price appreciation on homes. And that is exactly what we have seen for many years here in the Grand Rapids area. If you're running between 3 and 4 months of inventory, you would generally experience single-digit price appreciation. If the inventory built to where you had between 5 and 6 months of inventory, this is more of a normal, balanced, or neutral market where you might experience some price appreciation, but it would more than likely be in the low single digits. And if you're under 5 to 6 months of inventory, this is considered a seller's market. And that's exactly what we have seen for many years here in Grand Rapids. If you're over 6 months of inventory, this is considered a buyer's market. And if your inventory built to between 7 and 8 months, that's when you would most likely experience single-digit price depreciation And then if the inventory built to 9 months plus, that's when you would likely see double-digit price depreciation. So 7 to 8 months of inventory, single-digit price depreciation, 9 months plus, that's when we start to get into double-digit price depreciation. Are you looking for a realtor you can trust? If so, look no further. When you are ready, let me put my decades of sales and business experience to work for you. Call me directly at 616-258-4782 to discuss your situation or to just talk about real estate. I look forward to helping you succeed. Once again, that phone number is 616-258-4782.